Welcome to another episode of Making Risk Low. Our guest today, it's a literal cornerstone of the private equity world. As the co-president and chief investment officer of Stonepoint Capital, he oversees massive portfolio focused on the intersection of financial services, insurance, and technology. He's been a driving force at Stonepoint for over 25 years, helping lead the firm's evolution into the powerhouse it's today. Prior to that, he cut his teeth in the financial institutions group at Goldman Sachs. He's also very widely regarded as the insurance guru, often sought out for his perspective on how technology and private capital are reshaping insurance and agency landscapes on both sides of the market. His expertise expands from the full spectrum of financial services with a deep specialty in insurance services, asset management, and financial technology. Please welcome a man who is arguably one of the most influential voices in the insurance and fintech space today, Nicolas Zerbib. Nick, thank you so much for joining me today.
Juan, thank you for having me. And I'm not sure I deserve any of those nice things that you said, but thank you.
So, looking at your background, you've lived in many different countries throughout your life. Then you majored in history at university. So the first question that came to mind is, has actually your study of history, is it helping you predict the future?
Yeah, boy, predicting the future is hard. Maybe you can learn and see some things rhyme over time. But I did buy Paradigm Shift a year or two ago, just as things started to accelerate in terms of the pace of change. So certainly looking at historical periods that experience massive change is helping me certainly kind of think through what could be ahead. But at the same time, it feels a little bit different this time. We'll see how it all plays out. But I'm still a student of history, and I'm brushing off the Paradigm Shift book.
There's probably not many events in history that are anything like what we're seeing now. Perhaps the Industrial Revolution was, you could argue, the closest, but there are not that many, right, that you can probably relate to.
Now the speed of adoption and the uh, the impact on the way we work and the workforce in general is something that I think a lot about, and I'm trying to read as much as I can about it. But it's moving awfully quickly, and it's obviously impacting a bunch of industries, which is one of the things we're going to talk about today.
Great, Dick. So let's jump into it. Let's jump into your views on the insurance industry and the shifts that are happening today, as you said. And private equity has traditionally been really in love with the brokerage model, right? It's got very sticky cash flows. It's predictable top line. In the last year or two, right, with autonomous agents, generative AI, do you still think that stickiness that kind of made you probably love agencies and broker business in the past, is that still real, or are you seeing a shift in those business models?
It's a great question. Look, I think we're still very bullish on the sector, and I think the reasons why insurance brokerage has been super attractive to private equity still holds. It's still non-discretionary spend for commercial lines in the U.S. It's highly recurring, as you said. The world is super complicated. There's more to think about, and for brokers to help clients around climate risk, geopolitical risk, inflation, litigation, medical cost inflation. And ultimately, our perspective and the perspective of the market for a long time has been that he or she who controls the customer ultimately wins and gains the most economic rent. That is changing a little bit as we think about AI. And I think it's incumbent on the insurance brokerage channel to embrace AI to stay relevant. The agents still control that relationship today with the ultimate insured, and so we're looking at that retention rate as the leading indicator of whether there's going to be massive disruption in the industry.
And do you think this applies across all segments of if we focus on commercial insurance, or are some segments more at risk?
Of course, we've talked about other geographies have had the adoption of direct to consumer, particularly around personal lines, much faster adoption than the U.S. So we principally focus on the U.S. market with some activities in Europe and in some of the Lloyd's wholesale businesses. But in the U.S. market, I think complexity is your friend if you're an insurance broker. So I think the more specialized the risk, the more complicated it is, the more it requires advice and analytics to make that placement. I think there are some moats around those businesses. Clearly, personal lines where there's more discussion of comparative raters that will allow you to transact more quickly is more exposed, particularly auto. Homeowners has been slower to adopt. It's more complicated to place. So certainly there is a complexity spectrum, and the more specialized, the more complex the placement, the more protected you should be as an insurance broker, and the more some of those, I would say, softer things like claims advocacy, like the power you bring for placing a lot of business, those things should protect the position of insurance brokers in more complicated risk placements.
Yeah, and then you were referring to the trends in the European market, and I think probably what's differentiated the segments that have gone more direct versus the one that are stickier with brokers it's probably who is the persona who's buying insurance, right? So that's obviously personal lines, which is typically an individual buying it, or the small segment of commercial lines, where you still have like probably not a professional risk manager purchasing insurance. It's like an owner of a small business. I think the moment you get into those slightly larger business, more complex risks, where you've got a professional CFO or risk manager actually doing the insurance purchase, those are the ones who really want to rely on a broker, right?
I think so. And that's certainly the case in the U.S. There's a view that perhaps more direct distribution of small commercial will open up that market, and it will be a growth vector because a lot of those companies may be underinsured or not fully insured. So I think there's an opportunity there. But the stat that's amazing, and it's certainly not indicative of where things are going to be going forward, is that agency distribution, the independent agency channel distribution for personal auto has been steady and actually rising a little bit over the last 20 years. It's all come at the expense of the captive channel. So direct distribution has grown. Independent agency has grown very, very modestly, but it's all come at the expense of the captive channel. I don't think the future will necessarily hold. I think there will be more direct distribution in personal lines going forward, but that's an interesting stat that we always look at.
And actually, really, I mean, there's been quite a lot of obviously movement in the valuation of brokerages in the last, I would say, few months, both globally, both in the US and in Europe. And I think we're seeing the recovery of those stock prices. So it's probably has like a K shape, right? With some of them recovering really quickly, some of them actually stagnating. So what do you think are the tech stack capabilities which kind of differentiate those that are outperforming those from a valuation perspective?
It's a really good question. I don't know that the valuation paradigm has been driven by the tech stack per se, because I'm not sure that the outside world understands fully the tech stack for some of the publicly traded brokers. I do think that there was a leg down in valuations last year around organic growth, and then there was another significant leg down in valuations driven by AI eats everything, including knowledge workers. And so I think those very small but very significant changes in the forward growth prospects of these businesses have caused them to be revalued. I do think that they will return. I think sustainable growth in these businesses is certainly GDP plus, but right now the perception is that it will be GDP minus. And so it's incumbent upon all of these players. And one of the public brokers spent their investor day discussion last week talking about AI as a major cost enhancement driver across a bunch of different areas. I think understanding that these brokers have tools to ways to utilize AI that will drive down their cost structure in the short term is imperative, because the channel is absolutely adopting AI and it is embedding that into their workflows. But the market thinks that there's going to be disintermediation in the next few years, and I think that's, I don't believe that's the case.
Yeah. Okay. So you would argue it's less about the detailed tech capabilities. Obviously, they need to be making progress on AI, as you just mentioned. That it's going back to the previous question. It's more about the segment of the market they're operating.
It's all about growth. It's all about the growth rate, the organic growth rate expectations in 2025 as they looked out into 2026 went down. And then in 2026, what you had is the expectation that the growth would come down further because of this AI disruption and disintermediation. So I think it's all about how you think about terminal value and what the long-term growth prospects are of the insurance brokerage function in the economy.
Yeah, and the more complex the risk they are intermediating, kind of the more certainty around the long-term value. Yeah, that makes sense. You should be building on that theme of AI, right? So everybody has been talking about agentic AI in the last few months, and these are systems that are not just like suggesting a policy, but actually executing whole workflows, right? Executing replacement, renewals. So if AI will be able to actually automate that renewal process, like what is the role, or what's a high value role of brokers in those transactions in the future?
It's a great question. I think the agent and the broker are incredibly resilient as an industry and will adapt. I think AI and agentic AI tools will help certain discrete tasks. It should enhance account rounding. It should enhance the ability to figure out which markets want a certain type of risk. It should enhance the way you reconcile commissions. A lot of things that are clunky today and that require a lot of human intervention. It will automate renewals. So there are a bunch of discrete tasks that will be automated that are currently embedded. These capabilities are getting embedded into the workflows and the BMS, the broker management software systems that the agents use. Ultimately, we go back to a couple of fundamental tenets that make insurance brokerage interesting, and the brokers will have to double down on these tenets so that AI is an enhancer, an enabler, and not something that disintermediates them. Number one, it's the regulatory risk and all of the compliance that goes into placing insurance. Insurance is complicated. There are 50 state regulators in the U.S., and there is both admitted and non-admitted. I think that's a barrier to entry, and that will enhance the complexity. There is the variable cost of distribution. I think it's easy to think about sort of direct to consumer and placing insurance directly, but you forget that the beauty of the insurance brokerage channel is a variable cost model. And there are only a few big brands in the US that can actually afford to build powerful brands. The other thing is E&O risk. There's errors and omission that sits with the insurance broker. And I think that's something that the agentic AI, I'm not sure the big LLMs will want to own that risk. So I think you'll probably have a couple of situations where something breaks down and some of that liability might make its way all the way back to an LLM. And I think those are deep pockets. So the beauty of the broker function is they own that E&O risk for mistakes. And then the last two things that are scale items, which perhaps purely agentic AI agent might be able to replicate, but it'll take a long time, is claims advocacy. Insurance is all about getting the right protection, but also having somebody advocate for you when you have a loss. The brokers at scale do that very well. And premium scale. Increasingly, the brokers are developing homogeneous books of business that they can turn into programs and get a lot closer to the risk placement. I'm not sure in the next few years, an agentic AI kind of an agent, a purely sort of LLM-driven agent, will be able to provide those capabilities. So we go back to what makes a broker and an agent unique. AI will drive efficiencies in the short term. In the long term, they need to make sure they double down on these tenets to stay relevant and to stay really important in the channel.
Yeah, and I think that evolution is something we're seeing across the value chain. It's like AI, Gen AI automating the like simpler tasks, driving efficiency, but really then enabling the brokers and the carriers to really deploy the human capital into what really can make or break their business, right? Their E&O risk, compliance, regulatory risk. What did you mean about the variable cost of distribution? I didn't fully follow that one.
Oh, what I meant is I think it's hard to build a brand in insurance. So the agent's function is to go from one to many and to find the right market appetite. In the U.S., at least, there's only one large carrier that has built both a direct to consumer brand and a brand that's distributed through agents. It's Progressive. Nobody else has done that. So everybody's either through the independent agency brokerage channel. And so I think it's very, very expensive to build the capabilities. And in commercial lines, carriers have different appetites that change over time. So for you to know where to go, and perhaps an agent, an AI agent could figure it out. It certainly doesn't lend itself to direct distribution, and the consumer, the insured, will not know where to go because there's no brand building in those areas. They would rather the carriers would rather use a variable cost distribution model, and perhaps your point maybe is that the agentic AI concept could be that direct, that variable distribution model as opposed to a human brokerage. But my view is the human brokerage will use the AI capabilities to augment their internal functions.
That totally resonates. The AI will have the capabilities. The question is, how do you reach the end customer? And I think we've seen that very similar in the European markets, where many carriers decided to go direct. Pretty, it's like, okay, some customers might want to go direct, and somehow we save the recurring commission from the broker. And I think over time, what they realized is the one-off acquisition cost of direct customers often is higher than the recurring commission for a broker of the lifetime of the policy.
That happened with a number of the insurtechs in the US over the last 20 years. They started with direct models. The customer acquisition costs were prohibitive. They didn't have a brand. It's too expensive to build a brand. And so they pivoted to either a hybrid model or an independent agency model. So I think there are learnings there. Certainly, Google and Alphabet benefited from those dollars. All those people who tried to spend directly, but it's hard, and that's one of the reasons the independent agency channel has been so resilient for a long time. It's a variable cost distribution model.
And then talking about this, again, in the last couple of months, we've seen what many have referred to as the SaaS apocalypse. This has been across industries, but also in insurance. I think the rationale behind it is, okay, you could see AI first entrants lowering switching costs and compressing margins for traditional players. You've got a number of those traditional players in your portfolio. Like, what's your advice or your coaching to those portfolio companies on how to compete with them?
So look, I mean, first and foremost, it's about developing the capabilities to introduce and to roll out AI tools internally. So it's first and foremost, it's about efficiencies internally to be able to withstand any pressure. So medium term, short to medium term, there should be a very significant cost takeout opportunity. Whether people exercise it or whether it's a redundancy in the short term is a big question mark. So being able to build that muscle so that if there is pressure on the top line, which longer term you would expect commission rates to perhaps be under pressure if AI is widely adopted, is the number one source of advice, along with make sure you retain your business. The beauty of commercial lines insurance brokerage is on an account basis, you are retaining 90 to 95% of your accounts. And hopefully you're on the higher end if you're specialized. So focus on retaining your business, defend what you have while introducing AI capabilities into your workflow that over time could drive down costs. The public broker I was referencing had some amazing stats. So if you think about an insurance broker with 55% of their revenues represented in people costs, this broker cited that there could be a 20% reduction in the customer service capabilities. So if you think that's 20% of the revenue, that's a 4 to 6% improvement in margin or ability to kind of sustain pressure on the top line, and a 10 to 15% reduction in the support side. Support could be another 10 to 15%. So there's another 1 or 2 points. So if you're preparing for pressure that could come from competitive threats or from carriers reducing their commissions, you have to do that, and you have to have the flexibility to attack some of those costs in the short term. And I think there are blueprints, and certainly among the larger brokers who are really developing areas of costs that they could attack, or they could keep those costs constant and obviously grow more, which would be the more positive outcome for those brokers.
Yeah, but also reducing those or reducing the cost and increasing the margin should make them more competitive.
Absolutely. No, it's critical. It's absolutely critical. So in the short term, I don't know that there will be a lot of redundant costs because there's a lot of experimentation that's going on. There's a lot of fine tuning. I don't think people will take out the costs in the short term, but they have to have the flexibility, and they need to understand what those cost levers are, so that when that pressure comes, which it will come medium to long term, they can respond quickly.
So talking about the cost of doing business, the friction of the insurance value chain, one of the sources cited many times of that inefficiency in the value chain is that handshake between the broker and the carriers, right? And it's there's friction on both sides, right? So it's brokers need to ask for a number of, need to build a submission, which is time consuming, need to get a number of quotes from carriers, need to compare the quotes, make a recommendation. On the carrier side, you are dealing with documents, trying to underwrite the risk. So from your perspective, is there anybody in the industry who's really addressing that challenge of better connectivity across the value chain and really enabling a better flow of risk?
Look, there are a number of players, I think, who are moving in that direction very, very rapidly. I think so. I do think there are very important efforts being undertaken by the broker management software vendors to build more direct connectivity into the carriers, including with Cytora. So I think that's critical for the industry. It's critical for the insurance agents to be able to work more directly and to ingest data and share data back and forth with the carriers in real time. That will keep the channel much more competitive vis-a-vis new entrants. I think historically, the carriers, so this relationship between the carriers and the independent agency brokerage channel is a very complicated relationship. It's a win-win in the sense that it's a variable cost distribution model. However, what you've seen over the last several years is all the large carriers start to at least discreetly say that they're going to hedge their bets. They're going to effectively meet the client where the client wants to transact. So this notion of omni-channel. Today, they can't go direct. I would argue it's very expensive to go direct, but they want to have that option. So it's incumbent on the brokers and the agents to be much more seamless in their interactions with the carriers to stay relevant and to be able to stay competitive vis-a-vis some of these emerging players that you cited earlier. So I do think there's a huge wake-up call for the insurance brokerage industry driven by what's happened over the last few months. And it also it's incumbent on the insurance brokers to embrace the connectivity into the carrier so that they strengthen and solidify their link in commercial lines to the carriers who distribute their product through them.
Yeah, it's interesting when you say about the meeting the client where they want to be met. At least my experience in the last few years, I've heard less about that from a perspective of going direct, but we hear a lot of that in terms of meeting the broker where the broker wants to be met. Meaning, if the broker wants to come to our port, if you're a carrier, right? If the broker wants to come to our portal, fantastic. If they want to send it via email, great. Use our APIs, but really making it easier. If you're a carrier, you want to make it easier for the broker to do business with you.
Oh, you do. Listen, the broker meets a fundamental need for the insured. It's one to many. But that one to many interaction has been very, very clunky. It will get better with AI, with the ability to ingest disparate data more quickly. The question is, will there be an industry, sort of clearinghouse, or is everybody going to use their own AI capabilities to ingest the disparate data, or will there be some conforming kind of protocol or standard that will make it go faster? Our perspective is obviously, because we're heavily invested in the insurance brokerage channel, is the channel needs to continue to invest heavily and embrace their carrier partners. But I'm happy to hear you say that the carriers are wanting to do business in any way that the brokers choose. That I think that speaks to the balance of power. I'm not sure that balance of power will necessarily hold in the next few years. I think it may be shifting a little bit.
Yeah. And I think on your point on standardization of how risk information is captured, I think my strong perspective on that is this is something that has been tried to be done before with things like Accord and others. And I think the main challenge is that was a push for efficiency, but almost at the cost of enabling carriers to keep their view of risk. We had to conform to this standard, right? I think agentic AI now hopefully is going to be able to address both, right? It's like, how do you avoid commoditization of risk exposure and enabling every carrier to have their own view of risk while removing the friction of not having.
You're right. Yeah, the Accord form is very rigid, and or the list of questions that you're being asked are not the same ones that different carriers might want to know. So now you have the flexibility to have the best of both worlds. Perhaps a little more standardization with all the customization that goes on at the carrier level. So I think that will be super powerful, and the sooner that exchange of data and information is streamlined, the more competitive I view the independent agency channel vis-a-vis sort of a pure startup that's a pure AI driven kind of brokerage model.
So when you're looking at new deals, new opportunities to invest as part of Stonepoint, right? And you're looking at agencies or brokerages, how much do you focus on these kind of all these aspects that we've been discussing about their ability to exchange data in real time with carriers, or basically how tech-enabled they are? Is that like a core component? I mean, you mentioned earlier something which is very important for you is what segment of the market they participate. Like, what are the elements that you focus most on?
Yeah, look, I think it's an element that we're increasingly focusing on today. Look, historically, retention and sales velocity, sort of how, what was your organic growth engine, were more important indicators of sustainable competitive advantage. I think those are still the core indicators, but I do think that going forward, understanding how you are capturing the data, what kind of a data lake do you have, and are you using that data as a competitive advantage? Are you using it as a way to essentially turn homogeneous risks into programs? Are you using it to help place and get better placement rates with your carriers? Are you turning them into MGAs? those are increasingly important drivers of value creation for these brokers, along with, are you really thinking about how to affect the cost structure in the medium term? Those are the areas that we do spend time on as we underwrite new investments. But the first principle is: are you retaining your business? That's core. Do you have a sales engine? Can you recruit and retain and drive organic growth? And then the cost levers that we're describing in terms of transferring data to the carrier and driving some of these agentic tools into your workflow are positives and are positioning you for the future. And increasingly, those are going to be key criteria for us to evaluate new investments. But those are all really key criteria that we evaluate.
I would just see them both are actually related, right? I mean, if you're focusing on how tech-enabled they are, is because you believe that is a early indicator of how well they will be able to grow and retain in the future, right?
Absolutely. I think they are inextricably linked. There is sort of an element of complexity, technology. The new tools will help with the more complex risks, but the specialty lines businesses are the businesses that we like, that we've liked for many years because we think they're more sustainable. But you see that in retention ratios. You see that in account retention. And that's the defensive nature of the business. Now, to keep that lead that you have as an insurance broker vis-a-vis new entrants and AI and agentic AI, you need to introduce your own tools to maintain that lead and to build a little bit of a buffer for when commission rates might come down.
And do you see a big gap between the retention rate of the highest performers and the lower performers? So how wide is that gap?
It's a very significant gap. I think there's the drivers of organic growth over the last several years have been obviously account retention, which there could be a gap of 5 points. And then sales velocity. How successful are you in sort of driving new business? The revenue retention has had a nice uplift driven by rates until really until 12 months ago when rates started to subside. But organic growth could be 5 points different between the best performers or more, and that was driven. I would say 50% of that delta would be enhanced retention for some of the best performers, and the other 50% would be sales velocity.
Yeah, if you're not managing to retain your book, it's like almost like no matter how fast you add new clients, you're just making up for the ones that have churned, right? So
Yeah, no, that's priority number one. In fact, account rounding, cross-selling, earlier remarketing for your renewals, all the things that AI will enhance the workflows for the customer service rep who is renewing and making sure your account is properly covered. Those things should enhance in the short term, should enhance retention. The one thing that goes against retention is in a soft market, there's more shopping. I should say in a hard market, there's more shopping. Right now, there are pockets of the market that are hard on the casualty side and pockets that are softer. So it depends. But I do think retention is going to be the key indice, the key area of focus to see if the broker channel is as resilient as we think it is.
So if we look looking forward, right? The next, I mean, again, we started this episode talking about your history major and how that allows you to predict the future, which it was a bit of a joke, right? But the if you think about in the next few years, and I want to focus on talent now, right? And we've been talking about the shortage of talent in the industry. About there's some stats around in the next 5-10 years, 30% of the underwriters or the brokers will retire. There's not enough new joiners. What are your views on what's going to be the impact of AI on that? Is AI going to kill the entry jobs, and then we have a bigger issue 10 years down the line? What's your views on kind of the intersection of AI and talent?
there are a lot of things around AI that concern me. This is one area where I'm actually much more optimistic. There is an enormous amount of quote unquote tribal knowledge in insurance, and it's a graying industry. I can say that as somebody who's gray, and so you are trying to bring in new talent into the industry quickly, because you do have individuals who are going to be retiring over the next 5, 10, 15 years, and so what we're seeing in some of our more forward-leaning insurance brokers are AI coworkers who are getting trained by the more seasoned practitioners, the industry specialists, individuals who understand cost containment for a mid-sized employer around group health, and embedding a lot of that knowledge and information into a coworker, and that coworker will really accelerate the ramp up of new hires. So if you're bringing somebody who's empathetic, who's a good salesperson, who understands how to interact with people and socialize with people, but he or she may not have the industry expertise, you're going to be able to get them up to speed much, much faster. They'll have more usable tools to learn, the specifics around different types of risk placements or different types of industries. And I think that will be a net positive for hiring, for essentially ramping up and validating what are called newbies, so new hires into insurance brokerage. I think the same applies with insurance underwriting as well. I'm giving you the insurance brokerage perspective, but I think it applies across the industry.
Yeah, and that is from a perspective of how do you onboard and train new joiners. I think the other Sam's historical challenge was how do you attract young talent into the industry, and I think part of it was it was so manual, and like if you sat next to a broker or an underwriter, a lot of their day to day was quite manual. You could argue that by leveraging AI, you're going to make it more attractive.
I think you'll make it more attractive. I also think that you're dealing with risk, with human capital, with things that are very, very dynamic. And as one very savvy insurance broker explained to me when there was a massive regulatory change impacting his end market, he said, "This is our Super Bowl. This is our World Cup. The more complexity, the more upheaval there is in sort of how people think about placing certain types of risks, or if there is a crisis in the world, or if there's litigation inflation, the better for the broker." So I think people who are interested in a dynamic environment, where some of the more rote aspects of the job may be taken over by AI, but like to deal with people, like to understand different types of businesses, like to adapt to how the situation will change. Because again, market appetite from different carriers changes over time. So you have to understand that, but you also have to understand the emerging risks that your clients have. So I do think insurance brokerage will become a more appealing, more interesting, in insurance underwriting, a more interesting area for folks to pursue going forward. And risk bearing is not going away, notwithstanding AI. I think somebody needs to bear the ultimate risk of geopolitical risk, climate, all the things that are quite prevalent in today's world, unfortunately.
One final question to wrap it up, Nick. Obviously, there would be a number of people listening to this episode who have set up or are setting up a broker. They're thinking about a potential exit in the next year, 2, 5, whatever, to a private equity firm. What advice would you give them now, or almost like what are the things you're going to look for when considering the deal?
Yeah, I think it goes back one to a couple of the fundamental tenets. Defend your book. That's the demonstration that you're adding value. So really double down on account retention. And at the same time, I think what's important if I were running an agency today is to identify 1 or 2 or 3 areas on the servicing side where AI over time will have a meaningful impact in my cost structure. And so not necessarily to drive down the cost today or tomorrow, but to have the flexibility to adapt to an environment where the revenue profile of a broker might come under some pressure. So those are the two things that I think I would focus on if I were running an agency and I wanted to be resilient and I wanted to demonstrate that I'm forward leaning. And then there are all the other things that you do as an independent agent that will make you, I think, a durable and sustainable business. All the claims advocacy that we talked about, and obviously negotiating better deals and creating programs and facilitating placements with some of your better carriers. But the first two tenets I think are important. It's going to be back to the basics: retention and being able to manage your cost structure more aggressively with AI. I think those will be the tenets of success going forward.
Well, so now, Nick, you'll have a great way of knowing who's listened to the episode if when they pitch to you that those are the two things on the first slide of the pitch deck.
We'll see. I certainly hope a few people listen, but it's been fun chatting with you. These are really important topics for the industry, and I enjoyed our conversation.
Nick, yeah, it's been an absolute pleasure. Thank you for taking the time to join me for this episode, and it's been a really insightful episode. So yeah, stay in touch, and thank you so much, Nick.
Thank you, Juan.